Is Supermicro the AI stock of the year? Or a risky bet? Let's find out. Supermicro was once the hottest AI stock on Wall Street, but now it's down nearly 60% from its peak. Some say it's the best AI value play of the year, while others think it's too risky to touch. Can Supermicro make a comeback? Or is this a value trap? Hi. In today's video, we're going to explore whether Supermicro SMCI, is the best AI stock of 2025 or a ticking time bomb. Welcome to the Finance Savvy. If you love deep dives into AI stocks, quantum computing, and cutting-edge tech investments, hit that subscribe button and stay ahead of the game. Let's dive in. Supermicro's AI hardware edge. Is it a game changer? Supermicro or Supermicro builds server hardware, the backbone of AI. With AI demand soaring, companies need powerful computing infrastructure. But here's the problem. Server hardware is highly commoditized, meaning competitors like Dell and IBM are all fighting for market share. So why should we care about Supermicro? The answer lies in its secret weapon, DLC technology. Supermicro's direct liquid cooling, DLC, technology gives it a competitive advantage. Instead of relying on traditional air-cooled systems, DLC saves 40% energy and reduces space by 80%. In an AI-driven world where efficiency is everything, this cutting-edge cooling tech makes Supermicro an attractive player in the market. But here's where things get tricky. Accounting issues and SEC filings. A cause for concern? Supermicro's stock tanked after a short seller report from the now-defunct Hindenburg Research accused the company of accounting manipulation. This triggered an official Department of Justice investigation, and their own accounting firm resigned, a major red flag for investors. The company has since hired a new accounting firm, and an independent audit found no wrongdoing. But Supermicro still hasn't filed its 10K annual report or 3 quarterly earnings reports. Investors are left trusting management's word instead of official SEC filings. That's a huge risk, and explains why some investors are still hesitant to jump in. Slowing growth, a major red flag? On the surface, Supermicro looks like a growth beast. Revenue surged 54% year over year, hitting $5.6 billion in its latest quarter. Sound great, right? Well, not so fast. Despite strong growth, Supermicro keeps lowering its revenue projections. First, it expected 2025 revenue to be between $26 billion and $30 billion. Now, that estimate has dropped to $23.5 billion to $25 billion. That's a huge downgrade. If management keeps adjusting expectations downward, investors will start losing faith in the company's ability to execute. So why is the stock still up 45% since earnings? Because despite all these risks, Supermicro's stock still looks cheap compared to other AI stocks. Is Supermicro a buy? Or is it too risky? Supermicro is a classic high-risk, high-reward investment. 1. Bull case. Supermicro has cutting-edge AI hardware, is still growing fast, and has one of the best cooling techs in the industry. Plus, at 18x forward earnings, it's much cheaper than AI giants like NVIDIA. 2. Bear case. Delayed SEC filings, a history of accounting concerns, and slowing revenue growth make it a risky bet. So should you buy? That depends on your risk tolerance. Personally, I'm steering clear, at least until Supermicro files its missing financial reports and proves that its growth trajectory is stable. Instead, I'd rather put my money into AI stocks with clearer growth paths and fewer accounting red flags. Speaking of AI stocks, what's next? The future of AI investing. If you're looking for game-changing AI stocks, there's another company I have my eye on, Palantir, PLTR. Could Palantir become a $1 trillion company in the next 5 years? Well, it has a massive moat in AI-driven analytics, huge government contracts, and is leading AI-powered defense, healthcare, and enterprise tech. Some investors believe Palantir is on the verge of something huge. So, if you want to know whether Palantir is the next AI giant, check out my upcoming deep dive on Palantir's $1 trillion potential. Final thoughts. Again, thanks for watching. If you found this video helpful, don't forget to A. Like this video. B. Subscribe to the Finance Savvy. C. Drop a comment below. Would you buy Supermicro, or is it too risky? Stay tuned for my next video. Can Palantir become a $1 trillion company in 5 years? See you in the next few seconds. Could Palantir be the next $1 trillion AI stock? Or is it overhyped? Let's break it down. AI stocks have been on fire, with companies like NVIDIA, Supermicro, and Palantir grabbing headlines. But could Palantir really hit a $1 trillion valuation by 2030, as some analysts predict? Or is this just wild speculation fueled by the AI hype? Welcome to the Finance Savvy. In today's video, we're diving deep into Palantir's explosive growth, its AI dominance, and whether it has what it takes to join the $1 trillion club. Don't forget to subscribe for the latest stock market insights and investing strategies. Now let's jump right in. Palantir, the next AI giant or just another hype train? If you've been following the AI stock boom, you know that companies like NVIDIA, Microsoft, and Alphabet have already cemented their positions in the $1 trillion club. But unlike these tech giants, who dominate multiple industries, Palantir, PLTR, is a pure-play AI software company. This makes its potential both unique and uncertain. Palantir's rapid growth. A look at the numbers. Palantir has come a long way since its 2020 IPO, expanding beyond its government contracts into the private sector. This transition has supercharged revenue growth, driven by its artificial intelligence platform, AIP, which helps businesses leverage AI for data analysis, decision-making, and operational efficiency. Here's how its revenue has stacked up over the years. A. 2021, $1.1 billion. B. 2022, $1.9 billion. C. 2023, $2.2 billion. D. Projected 2027, $5.9 billion. That's impressive growth, but is it enough to justify a $1 trillion market cap? The path to a $1 trillion valuation. Currently, Palantir's market cap sits at $260 billion. To reach $1 trillion by 2030, the company would need to, first, maintain a 30% plus annual growth rate, which is possible but challenging. Second, expand its AI software dominance in healthcare, finance, and defense. Third, secure massive private sector adoption for AIP. Fourth, justify a high valuation while keeping investors bullish. The biggest obstacle? Palantir's sky-high price-to-sales (PS) ratio of 102, a valuation that's hard to sustain long-term. If it follows historical trends, a more reasonable PS ratio would be 23, which would cap its valuation at around $369 billion by 2030, far from the $1 trillion dream. So, is the Wall Street hype overblown? Is Palantir the next Oracle or Salesforce? Rather than joining the $1 trillion club, Palantir's trajectory might be more comparable to Oracle, or CL, or Salesforce, CRM. Both powerful software giants, but not $1 trillion stocks. Dan Ives from Wedbush Securities may be betting big, but realistic projections suggest Palantir will still be a major AI force, just not at a $1 trillion level. For long-term investors, this means Palantir is still a strong growth stock, but it's crucial to manage expectations rather than assume it will reach NVIDIA-like heights. Final thoughts. Should you invest in Palantir? A. Palantir is one of the most exciting AI stocks on the market today. B. Its AI software dominance and government contracts give an edge. C. However, expecting a $1 trillion valuation by 2030 might be too optimistic. If you're bullish on AI and data analytics, Palantir deserves a spot on your watch list, but keep your expectations in check when it comes to $1 trillion predictions. Again, thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe to the Finance Savvy for more insights. Got questions? Feel free to reach out. We'd be happy to help.